There's a rule in the tax code right now that can quietly take over $75,000 from you when you sell your home. Not because you did anything wrong, not because you broke a law, just because of a technicality most homeowners don't even know exists, and no one from the IRS is going to warn you about it. I'm going to break that down clearly. But before we get there are a few other changes happening right now that matter just as much. Some of them cost people money immediately. Some of them could save you thousands if you even know they exist. And almost none of this is explained in plain English. If you own a home and you're getting close to retirement or already there, this is the kind of stuff you want to understand before it hits you. Let's start with the one that's already costing people money right now. When you had a job, taxes were basically on autopilot. Your employer handled it. Money came out of every paycheck. You didn't really have to think about it. Then retirement happens, and that system disappears overnight. Now your income is coming from different places. Social Security, maybe a pension, IRA withdrawals, investment income, maybe even rental income. And here's the issue. Most of those sources don't withhold the right amount of tax, or sometimes any at all, unless you set it up. So you get to the end of the year thinking everything is fine, and then you find out you didn't pay enough. And that's where the IRS penalty kicks in. They don't just care that you pay your taxes, they care when you pay them. They expect those taxes to be paid throughout the year in 4 installments. Miss those or underpay, and they add a penalty. Right now, that penalty is roughly 7 to 8% annually on whatever you underpaid, calculated quarterly. So even if you didn't know, even if nobody told you, you can still get hit with it. And that's the part that catches people, because nobody really sits you down when you retire and says, hey, this part just changed. Now, there is a waiver in some cases, especially if you recently retired after age 62, but you have to request it. It's not automatic. If you don't ask for it, you just pay the penalty and move on, never knowing you could have avoided it. So the simple fix here, look at last year's tax return. If you owed more than about $1,000 after withholding, you probably need to be making estimated payments now. That alone can save you from a surprise bill later. But compared to what comes next, that penalty is small, because there's another rule that's been sitting there for decades, and it's hitting more people every single year. And this one is frustrating, because it wasn't supposed to affect most people. It was originally aimed at higher income retirees. Now it hits the majority. This is the Social Security tax. Most people assume Social Security is already taxed money. And they're not wrong. You paid into it for years. But once you start collecting, a portion of it can be taxed again. And it all comes down to something called combined income. That's your regular income, plus certain other income, plus half of your Social Security. That total determines how much of your benefits become taxable. And the thresholds, they haven't changed in over 30 years. Not adjusted, not updated, nothing. So what used to be considered higher income now hits people living pretty normal retirement lives. And that's how more and more people get pulled into it every year. Even a small increase, like a cost of living adjustment, can push you over the line. So you get a raise, but keep less of it. That's the part that doesn't feel right. Now there is some relief built in, but it's buried. There's a newer deduction specifically for seniors, about $6,000 per person. It was designed to offset some of this, but you have to know it exists and make sure it's actually applied, because not every system catches it automatically. Now, while that's happening, there's another shift most homeowners missed. The SALT deduction cap. For years, you were limited to deducting $10,000 in state and local taxes. And for a lot of homeowners, especially in higher tax states, that meant losing thousands in deductions. That cap has been raised significantly. Now, for many people, itemizing deductions actually makes sense again. But here's the catch. A lot of people switched to the standard deduction years ago and never switched back. They're still doing what they've always done, even though the math may have changed. So they're leaving money on the table without realizing it. That's why you don't guess here. You run the numbers. Now let's talk about something that went the other direction, energy credits. Solar, windows, insulation upgrades, you could get a solid percentage back. But a lot of those credits are gone now. And the detail that matters most is this. It's not when you paid for something. It's when it was completed and ready to use. So people who signed contracts, paid deposits, did everything right, still missed out because the project finished too late. That one detail has cost people thousands. And that brings us back to the big one. The rule that can cost you $75,000 when you sell your home. That's not how it works. To qualify for the capital gains exclusion, you have to meet a specific requirement. You need to have lived in that home as your primary residence for at least 2 out of the last 5 years before you sell. Not 20 years ago, not over your lifetime, the last 5 years. That's what matters. And this is where people get caught. They've owned the home forever. But they move out, maybe for health reasons, maybe to live with family, maybe just to simplify things. Time passes, then they sell, and they assume they qualify. But when you actually count the months, they're short, even by a few months. And if you miss that requirement, the exclusion is gone, which means you're paying tax on the full gain. And that's how someone ends up with a massive tax bill on a home they lived in for decades. There are partial exclusions in certain situations, especially health-related moves, but you need documentation. And you need to handle it correctly. Because once the sale is done, your options get limited. So if you're anywhere near that situation, don't guess. Count the months, seriously. That one detail can be the difference between paying nothing or tens of thousands. Now let me leave you with something simple that actually helps. Property tax exemptions. Almost every state has something for seniors. Reduced assessments, freezes, exemptions, but most of them are not automatic. You have to apply. And a lot of people never do. They keep paying the full amount year after year, not realizing they qualified for a reduction the whole time. That's probably the easiest win in this entire conversation. A quick call, a simple form, and you could be saving money every single year. At the end of the day, this isn't about complicated strategies. It's about understanding how these rules actually work before they hit you. No letter, no alert, no reminder. They just happen. And by the time most people notice, it's already cost them money.